Okay, let's get into this. We hear it all the time, see the ads, maybe even get warned off it. Is trading like a real way to make money these days in 2025?
Or is it just, a quick way to lose everything?
Exactly. And let's be honest, the warnings, they often have a point. A lot of people do lose money trading.
They really do. But what if you've actually thought about it seriously? You've looked past the hype and you're thinking, okay, maybe this is something I want to explore, but properly, methodically.
Right. You want a real process.
That's exactly what we're tackling today. We're doing a deep dive into this YouTube transcript from a stock market educator. They really pull back the curtain.
Sharing their own experiences.
Yeah, their own journey. But more importantly, they lay out this 7-step roadmap. It's specifically for someone who's serious, who wants to start trading now.
Okay, so our mission here is to unpack that roadmap. Let's pull out the most critical bits, the insights. What does this educator say it actually takes to get started?
What are the real steps? The hidden challenges, maybe?
Yeah.
And what's the potential, the reality, if you really commit to this?
Not just the dream, but the day-to-day.
Precisely.
Mm-hmm.
Getting past all the noise and looking at the actual process, and honestly, the mindset needed, straight from someone who says they're in the trenches doing it.
Perfect. Let's jump straight in then. Step one on this roadmap.
Step one, it's fundamental. You got to decide where you're going to trade.
Okay.
And the source really focuses on two main playgrounds, especially if you're based in India. That's the India markets and the crypto markets.
Right, Indian markets. We're talking Nifty, Bank Nifty, Sensex, the big indices.
Yep, those equities, but also commodities, things like gold, silver, crude oil, traded via MCX.
Gotcha. And they mentioned Forex.
Briefly, yeah, but mainly to say, look, it's not legal in India for retail traders doing it that way. So for this audience, that kind of takes it off the table right away.
Okay. Now, the source makes a really interesting point about trading Indian markets, at least with their approach. Capital, big capital.
Yeah, this is a major reality check they throw in early. They talk about needing very large capital for their specific strategies to work well there.
Like how large are we talking?
Well, they illustrate it by explaining they don't just trade with cash reserves. They leverage assets they already hold, like ETFs, by pledging them.
Pledging. So using existing investments as collateral to get trading margin.
Exactly. It lets them deploy way more capital than they might just have sitting around in cash. Their view, based on the transcript, is that for the good strategies in Indian markets, you probably need upwards of 1 lakh, maybe more, just as a baseline.
Wow, okay. Over a lakh just to get started properly with certain strategies. That kind of pushes back hard against the start with 500 idea you sometimes see.
Definitely. And the goal there, with that large capital, isn't necessarily huge percentage wins every day.
Right, they mentioned aiming for smaller percentages.
Yeah, like maybe 0.2% to 0.6% daily gain potential, perhaps aiming for 1% to 2% a month on that big capital base. It's more about consistency relative to the capital coupled with really tight risk management.
Like limiting losses.
Yeah, they mentioned trying to keep daily losses capped, maybe around 1%. The Indian markets, in their view, tend to have lower volatility compared to
Well,
the alternative.
which brings us to crypto. And the picture painted there sounds completely different.
Oh, night and day. The source is really clear. You don't need that huge starting capital in crypto.
Who could start smaller?
Much smaller. They even mentioned trading crypto options for as little as like 100.
Okay, that's more accessible, but what's the catch?
The catch is volatility, extreme volatility. They give this great example. Bitcoin moving 4.7% in a single day.
4.7%.
Yeah, and this was on a normal Monday, no major news event driving it. That kind of percentage swing on something like the Nifty. Very, very rare without some big catalyst.
And that volatility, I guess, is why even small capital can see those potentially huge percentage swings, both up and down.
That's the double-edged sword, exactly. And then there's leverage.
Leverage amplifies everything.
Hugely. The source mentions seeing leverage up to 200x available on Bitcoin. Think about that for a second.
200 times.
Yeah. So if you put in just 1,000 of your own money, you could potentially control a trade size worth 2 lakh.
That's incredible.
It unlocks that potential for massive percentage gains on your small stake. Absolutely. But, and it's a big but, a tiny price move against you can wipe out your entire 8,000 instantly. High risk, high potential reward, amplified.
You also mentioned MCX options earlier. For things like gold, can you trade those in smaller sizes too? Or is it big contracts only?
No, they clarified that. You don't have to trade the full, large gold futures contract. There are smaller options like gold mini, gold pedal.
Yeah.
even something called Gold 10, which is just for 10 grams.
Okay, so there are some smaller options there too.
Yeah, but they likely still require a bit more capital than starting with, say, 100 euros in crypto options. It's all relative.
Okay, so let's sum up step one for you listening. Choosing where to trade really boils down to your starting capital and how comfortable you are with big price swings.
Right. Crypto lets you start small, potentially very small,
Mm.
but you need nerves of steel for that volatility and the risks that come with leverage.
Whereas the Indian markets, at least according to this source's strategy discussion, seem to demand significantly more capital up front for potentially less volatile trading, aiming for smaller percentage gains. Still risky, obviously.
Absolutely. Risk is always there.
Mm.
Okay, moving on. Step 2 is picking your platform, the broker or exchange.
Okay. For Indian markets, the advice seemed pretty standard, didn't it? Go with a discount broker.
Yeah, basically. Keep your trading costs low, save money on brokerage charges. That's crucial over time.
Makes sense.
And the source also gave a bit of reassurance about safety in India,
Mhm.
which is important. They pointed out that brokers are SEBI registered, regulated.
Right.
And crucially, your money and your shares aren't just sitting with the broker. They're held with a central depository, like CDSL or NSDL.
Ah, so there's a separation.
Exactly. It adds a layer of safety. Even if, worst case, your broker had financial problems, your assets held by the depository are generally protected.
That's good to know. It builds some trust in the system. Now, crypto platforms, that sounded a bit more like the Wild West, maybe. A bit riskier.
Well, potentially. The source suggests looking for platforms that are FIU registered in India. FIU is the Financial Intelligence Unit.
So, registered with the government.
Yeah, which gives some level of oversight, some feeling of legitimacy. BUT. And this was a huge but from the source.
It's not a guarantee.
Not at all. They were very clear. FIU registration does not guarantee your funds are safe. They even mentioned past issues, citing the WazirX example where users apparently had problems accessing their crypto holdings.
Okay, so FIU registration is like a check mark, something to look for, but definitely not a foolproof safety net for your money in crypto.
Exactly. You still need to be cautious. And this led them to talk about a specific type of platform they use, mentioning Delta Exchange India as an example.
Right, and this is where they made that distinction about what you're actually trading.
Yes, this is really important. On platforms like that, the source explains, you're generally not buying and holding the actual cryptocurrency, like owning Bitcoin itself.
So what are you doing?
You're engaging in what they call speculative trading. You're trading on the price movements, betting on whether BTC USD, for instance, will go up or down.
Okay, trading the price, not owning the coin. Why does that technical difference matter so much?
Well, this technicality, according to the source, leads directly to a massive point that connects step 1 and step 2, taxes, the tax implications.
Oh, right. The tax difference they highlighted was huge depending on how you interact with crypto.
It really is, and potentially a game changer for some. The source broke it down like this. If you buy actual crypto coins, hold them, and then sell for a profit, like an investment.
You get taxed heavily.
Yeah, flat 30% tax on the profit. Doesn't matter what your normal income tax slab is, 30%. Plus, TDS gets cut too. That's a big chunk of your gains gone.
Okay, 30% flat tax plus TDS on crypto investments. But what about that other way, the speculative trading?
This is where the source presented a potentially significant advantage, especially if you're starting small. According to their explanation, income from that specific type of speculative trading falls under speculative income.
And that's taxed differently.
Yes, it's taxed according to your normal income tax slab. The source specifically implied that in this scenario, you don't face the flat 30% tax or the TDS.
Whoa. So if your total income is low, maybe below the tax-free limit, your profits from that specific kind of crypto trading could potentially be taxed much less than 30%, maybe even zero.
That's the implication, yes.
Yeah.
Whereas profit from actually buying and selling the coins would still get hit with that flat 30%.
That's a massive difference in your potential take-home profit, especially if you're just starting out.
It's a critical point the source really hammered home. You have to understand this tax difference when deciding how you'll approach crypto trading. It could make a huge difference to your bottom line.
Okay, fascinating. Going back to the platforms and safety for a sec. The source had a very practical tip for managing risk, especially on those crypto platforms, right?
Yes, absolutely. Given that FIU registration isn't a guarantee, they strongly advised only keep the bare minimum needed for your immediate trades on the platform itself.
Don't leave large sums sitting there.
Exactly. And they showed how practical this is because many platforms apparently offer instant deposit and withdrawal using things like IMPS or UPI.
Like moving money in and out quickly.
Yeah, the speaker even showed an example depositing 1 lakh instantly, doing some trading, and then withdrawing it right away.
That's smart. So you limit your exposure if the platform ever has issues. And honestly, it probably helps with discipline too, right? Makes you consciously decide to fund a trade rather than just clicking away.
That's a great point. It's risk management for your capital, but also maybe for your trading psychology.
All right, so we figured out where to trade and what platform to use, mindful of safety and taxes. Step 3 is key. Have strategy.
You absolutely need a method, a plan. You can't just guess.
So what did they suggest for beginners?
They recommended starting with priced action trading, basically learning to read the charts.
Looking at price movements, support, resistance, candlestick patterns.
Exactly that. Understanding the market structure directly from the price itself. They felt it was a good foundation for someone new.
Okay. But the educator themselves, particularly for their bigger Indian market trades, uses something different now.
Yeah, they mentioned their main method now is algorithmic trading, algo trading.
So automated, computer programs making the trades.
Pretty much. The strategy is coded, and the system executes it. They even joked about how sometimes they don't even know the specific trades the system is taking because the algo just runs based on its rules.
Okay, quite a contrast there between starting with manual price action and moving to complex algos. So you've got your strategy. Step 4 is critical, they said. Before you risk any real money, backtest your strategy.
Non-negotiable, according to the source. You absolutely must test your strategy on historical data first. See how it would have performed in the past.
And they mentioned tools for this.
Yeah, they brought up platforms like Algorooms as an example of where you can do this kind of back testing.
And they shared some real numbers from a backtest they did, right? On an option buying strategy.
They did, which makes it concrete. They tested a specific strategy over 2 years, trading just 1 lot. The backtest showed a potential profit of around 1 lakh over that period.
Okay, that sounds good, but profit isn't the whole story, is it?
Not at all. Just as important, the backtest revealed the risks. It showed a maximum drawdown of 24,000.
That's the biggest dip your account would have taken from a peak, the painful part.
Exactly. It tells you how much you might have lost during the worst period for that strategy. The backtest also showed things like the win percentage, about 53% winning days in this case.
So just over half the days were profitable.
Right. And it showed average daily profit, maybe 2,500, but also the maximum loss on a single day, which is around 3,600.
See, those numbers, especially the drawdown and max loss, are so important. They give you a realistic feel for the potential pain involved, not just the potential gain. A strategy could win 90% of the time, but if the 10% losses wipe you out.
Precisely. Backtesting helps you understand the potential performance, yes, but crucially, it exposes the strategy's potential weaknesses and its risk profile before you put real money on the line.
And finding those weaknesses naturally leads to step 5, which is improve your strategy and learn from mistakes.
Makes sense, right? You run the backtest, you see where it struggled, or maybe you make mistakes in your initial live trades later on. Humans aren't perfect. Strategies aren't perfect.
So this step is all about refining, tweaking the rules, maybe adding filters based on what the testing and experience show you.
Constant learning and adaptation. That seems to be the message.
Okay, strategy tested, maybe improved. Now, before going live, there's another practice step. Step 6, do demo trading.
Yeah, the simulation phase. Practice makes perfect, or at least helps avoid costly beginner mistakes.
So using virtual money in a live-like environment.
Exactly. Take your refined strategy and practice trading it without risking real cash. The source mentioned that the crypto platform they highlighted, Delta Exchange India, offers a demo account.
With virtual funds?
Yeah, they said it comes with something like $1,000, which is around $85,000 in virtual money to practice with.
Now, they were honest about demo trading, weren't they?
Oh,
Said
no.
the psychology is different.
Oh, completely. They were very upfront. Trading fake money just doesn't feel the same. You don't have that same fear when a trade goes against you, or the same excitement when it goes well.
So why do it then if the feeling is different?
Because, they argued, it's still absolutely vital for new traders. It's where you get comfortable clicking the buttons on the platform.
Muscle memory.
Yeah, executing trades smoothly, understanding order types, seeing if your strategy actually plays out in a simulated live market flow, and practicing crucial things like setting a trailing stop loss properly.
Ugh, the trailing SL. That's a good one to practice setting it up so it follows your profitable trade upwards, locking in gains.
Definitely. You want to practice using those tools before real money is flying around. Think of it like flight simulator time for a pilot.
You wouldn't jump in a real cockpit first day.
Exactly. Build confidence, get familiar, work out the kinks in the simulator first.
Okay, makes total sense. Which brings us finally to step 7. Start live trading. But the key word is small.
This is it, the real deal. But the advice here from the source couldn't be clearer, almost emphatic. Start tiny.
Don't jump in with your life savings.
Absolutely not. Do not put in a large amount of capital right away. Risk only an amount that, if you lost every single bit of it, it wouldn't devastate you financially or emotionally.
And this is where they really took aim at those flashy online portrayals of trading, isn't it?
Oh, yeah. They directly called out the fantasy. The idea you start trading Monday and buy a Ferrari, a Rolls-Royce, a Lamborghini by Friday.
Doesn't happen.
The educator literally said they guarantee their word that this will not happen for a new trader starting out.
That's refreshing to hear, actually. A strong dose of reality.
It really is. They were blunt. Trading is hard. It's a difficult business.
And losses.
Losses aren't just possible. They're inevitable. They happen to everyone. Experienced traders, including themselves, face losses. No strategy is 100% perfect. No person executes flawlessly every time.
So the real challenge in live trading isn't just finding winning trades, it's managing yourself. Discipline, patience.
And accepting losses is just part of the game, a cost of doing business almost.
And they added that point about mindset too, right? Don't take it personally.
Yeah, the market isn't out to get you. It's just the market. Millions of participants, countless factors. Your job is just to follow your plan and react based on your rules, not emotion.
Okay, so let's recap that 7-step journey quickly. First, decide where Indian market's needing more capital, maybe lower volatility versus crypto, low capital entry but high volatility, plus that crucial tax difference depending on how you trade crypto.
Right. Second, pick a platform, discount brokers for India, FIU registered for crypto, but be cautious. Maybe use speculative platforms, and definitely don't keep lots of funds on crypto exchanges.
Third, have a strategy. Maybe start with price action. Fourth, backtest it rigorously. Use historical data, understand the drawdowns, the win rates, the risks.
Fifth, improve that strategy based on testing and learning. Sixth, practice, practice, practice with demo trading. Get comfortable with the platform and execution.
And only then, step 7, go live, but start really small. Grounded expectations, discipline, accept losses, and forget the Lambo dreams for now.
It's a much more methodical, process-driven path than the hype suggests, focused on risk management from start to finish.
Which leads us to a final thought, something for you to chew on after this deep dive. Given everything this educator laid out, the difficulty, the fact that losses are certain even for pros, the need for intense discipline, and even their own stated goals of relatively small percentage gains on large capital.
Does that slow, steady, incremental path, starting small, managing risk constantly, accepting losses, does it actually align with the image many people have of trading? That flashy quick riches idea.
What level of commitment are you really prepared to make? Commitment to the learning, the testing, the small starts, the emotional control, understanding the very real challenges and risks this source highlighted.
It's something to really think about. Now, if you are interested in exploring this specific educator's approach further, they did mention a couple of things in the source.
Right, based only on what they said. Checking out links for platforms they mentioned, like Delta Exchange India for that speculative crypto trading, or Algorooms for backtesting.
Yeah, and they also mentioned something about a Google form to maybe join a crypto community they run or attend a webinar. And they even hinted at maybe getting access to some crypto algo trading software they use.
So specific next steps mentioned by the source if their particular approach resonated with you.
Exactly.
Yeah.
So thinking back over these 7 steps, was there one that jumped out at you as the most critical or maybe the most challenging?
Yeah, what questions did this whole deep dive spark for you? Definitely a lot to consider before jumping in.